Welcome back to the channel. If you're new here, my name is Maya, and this channel is all about building real financial freedom, not just chasing a bigger paycheck. Over the last few videos, we've talked about some important milestones: fixing spending habits, paying off debt, saving your first $10,000, and even how to invest that first 10Ks. But today I want to talk about something that can make an even bigger difference in your long-term results: avoiding the most common investing mistakes beginners make. Because investing doesn't require perfection, but avoiding a few major mistakes can dramatically improve your results over time. So let's walk through 7 investing mistakes that trip up a lot of new investors. The first mistake is trying to time the market. This is something almost every new investor thinks about. People worry about whether the market is going up or down. They wait for the perfect time to invest, but the truth is, consistently predicting market movements is incredibly difficult, even for professionals. Many successful investors focus on time in the market, not timing the market. That means investing regularly and allowing long-term growth to work in your favor. Think about it this way: if you miss just the 10 best days in the market over a single decade, your total returns could be cut nearly in half. The risk of being out is often higher than being in during a dip. The second mistake is investing money you might need soon. Investing works best when your money has time to grow. But if you invest money that you might need for rent, emergencies, or short-term expenses, you may end up selling your investments at the wrong time. That's why having a basic emergency fund before investing heavily can make a huge difference. It creates stability so your investments can stay invested. A good rule of thumb is the 5-year rule. If you know you'll need the money in less than 5 years, maybe for a house or a wedding, it probably belongs in a safe, high-yield savings account. The third mistake beginners make is overcomplicating their portfolio. When people first learn about investing, they often think they need dozens of different investments, individual stocks, multiple funds, constant adjustments. But many successful investors keep their portfolios surprisingly simple, often built around a few diversified index funds. Simple strategies are easier to maintain, and consistency is what really drives long-term growth. You don't need 1,000 different stocks to be truly diversified. In fact, many people build massive wealth using a simple 3-fund portfolio consisting of a total U.S. market fund, an international fund, and a total bond fund. That covers almost everything you need. The fourth mistake is letting emotions drive investment decisions. Markets move up and down. That's normal. But when prices fall, some investors panic and sell. And when prices rise quickly, others feel pressure to jump in at the peak. Both reactions are emotional responses. Long-term investing works best when decisions are guided by a plan. Psychologists call this loss aversion. Humans feel the pain of a financial loss about twice as strongly as the joy of a gain. That's why seeing red feels like an emergency, even when it's normal. The economic cycle has always included dips. Instead of reacting to short-term headlines, focus on the reason you started in the first place and stay disciplined. The fifth mistake is chasing trends. Every few years, there's a new hot investment. Sometimes it's a specific stock. Sometimes it's a new sector. Sometimes it's something everyone seems to be talking about online. But by the time something becomes extremely popular, it's often already experienced much of its growth. Building wealth usually comes from steady, diversified investing, not chasing hype. Think back to the dot-com bubble or more recent manias. When everyone is talking about a can't-miss asset, be extra cautious. Don't dive in headfirst with your life savings just because of social media pressure. The most reliable wealth is often built in the quiet, unexciting areas of the market. The sixth mistake is forgetting about fees. Fees might seem small at first, but over time, they compound. High management fees can quietly reduce long-term returns. Many investors prefer low-cost index funds because they keep expenses low while still providing diversification. A 1% fee might not sound like a big deal, but over 30 years, that 1% can eat up as much as a third of your final nest egg. That's potentially hundreds of thousands of dollars lost to management costs that you could have kept. Always check the expense ratio of what you're buying. In the world of index funds, you can often find high-quality options for less than 0.1%. Efficiency is your best friend. And the seventh mistake is simply not investing at all. Sometimes people spend so much time trying to learn everything about investing that they delay starting. They want the perfect strategy, the perfect moment, the perfect investment. But the truth is, starting matters more than starting perfectly. Even small investments can grow significantly over long periods of time, because the earlier you begin, the more time compounding has to work. The best day to start was 10 years ago. The second best day is today. Every month you wait is a month of compounding you'll never get back. Don't let the quest for the perfect plan stop you from taking action on a good plan. Just begin. The truth is, successful investing isn't about avoiding every mistake. It's about learning, staying consistent, and improving over time. It's a practice, not a destination. Most investors who build long-term wealth do a few simple things well. They invest regularly, they keep costs low, they stay diversified, and they stay patient. If you can do those things, you're already ahead of many people. You're building a future that your future self will thank you for. I believe in you. If you've started investing already, I'd love to hear your experience. Leave a comment and tell me what your first investment was. Was it an index fund? A specific company? Let's talk about it. And if this video helped you understand investing a little better, subscribe to the channel. We're building financial freedom step by step, talking about the real world. Thanks for watching, and I'll see you in the next one.